business valuation, newly added concepts. Another first one, valuation of distressed companies. Valuation of distressed companies. Methods for valuation of distressed companies. Another first method, modified discounted cash flow valuation. As per this, expected cash flow for T years equals to cash flow for T years into 1 minus probability of distress for T years. Discounted cash flow valuation plus distress valuation. In that case, valuation of equity, value of equity equals to discounted value of equity into 1 minus probability of distress plus distress sale value of the equity into probability of distress. Value of equity equals to discounted cash flow value of the equity into 1 minus probability of distress plus distress sale value of the equity into probability of distress. Next model, adjusted present value model. As per this, firm value equals to unlevered firm value plus tax benefits of debt minus expected bankruptcy cost from the debt. Expected bankruptcy cost equals to unlevered firm value minus distress sale value into probability of distress. Fourth method for valuation of distressed companies is relative valuation. Relative valuation multipliers such as revenue and EBITDA multiples are used, more popular measures, to value distressed firms than healthier firms, because multiples such as price earning or price to book value often cannot even be used for a distressed firm. Next concept, valuation of startups. Startup valuation can be done through three approaches: earning or cash flow approach, asset approach, market approach. What are the value drivers for startups? Product, management, traction, revenue, industry attractiveness, demand supply, competitiveness. Methods for valuing startups. First one, Berkes approach. The Berkes approach, created by American venture capitalist and angel investor Dave Berkes, looks at valuing a startup enterprise based on detailed assessment of 5 success factors, key success factors: basic value, technology, execution, basic value, technology, execution, strategic relationships in its core market, and production and consequent sales. A detailed assessment is carried out evaluating how much value the 5 critical success factors in quantitative measure add up to the total value of the enterprise. Based on these numbers, the startup is valued. Next, cost to duplicate approach. Cost to duplicate approach involves taking into account all costs and expenses associated with the startup and its product development, including the purchase of its physical assets. All such expenses are considered determine the startup's fair market value based on all the expenses. This approach is often criticized for not focusing on the future revenue projections or the assets of the startups. Next, comparable transactions method. With the traditional market approach, this approach is lucrative for investors because it is built on precedent. The question being answered is, how much were similar startups valued at? In comparable transaction method, we compare with similar startups. Next, scorecard valuation method. The scorecard method is another option for pre-revenue businesses. It also works by comparing the startups to others already funded but with adding criteria. First, we find the average pre-money valuation of the comparable companies. Then we consider how the business takes up according to the following qualities: strength of the team, size of opportunity, product or service, competitive environment, marketing, sales channels and partnerships, need for additional investment, others. Then we assign each quality a comparison percentage. Essentially, it can be on the par 100%, below average 100% for each quality compared to the competitors or industry. Next, first Chicago method. This method combines a discounted cash flow approach and a market approach to give a fair estimate of the startup value. It works out worst case scenario, normal case scenario, best case scenario. Valuation is done for each of these situations and multiplied with a probability factor to arrive at weighted average value. Venture capital method. As the name suggests, venture capital firms have made this famous. Such investors seek a return equal to some multiple of their initial investment or will strive to achieve a specific internal rate of return based on the level of risk they perceive in the venture. The method incorporates this understanding and uses the relevant time frame in discounting a future value attributable to the firm. The post-money value is calculated by discounting the rate representing an investor's expected or required rate of return. Valuation of digital platforms. Digital platform is a software-based online infrastructure that facilitates interactions and transactions between users. Principally, platforms are built to facilitate many-to-many interactions. Few illustrations are as follows. Few illustrations of kind of services provided are as follows. Marketplace. At marketplace, as search engine, repository, digital communication, digital community, and payments platform. How to value them? Income approach. In income approach, we use top-down approach and bottom-up approach. Next, discounting rate. The discounting rate used should be based upon the type of cash flows being discounted. The free cash flow to the firm should be discounted using KO, and free cash flow to the equity should be discounted using KE. As per CAPM, K equals to RF plus beta into RM minus RF. Next approach for valuation of digital platforms is market approach. Next approach is cost approach for valuing digital platforms based on cost. Market approach based on market price. Next, valuation of professional or consultancy firms. By using KPIs and benchmarks, we can compare them. Next, impact of ESG on valuation. Impact of each factor of ESG can be incorporated in computation of expected cash flows. E means E of ESG, environment. The risk of this factor can be incorporated by carrying out 2-degree scenario analysis. That is, if temperature of the plant is increased by 2 degrees. Similarly, adjustment in cash flows can be made by considering carbon points. S of ESG. The risk of this factor, social, can be considered by adjusting the impact of social measures cost on the revenue, such as better labor working conditions, CSR, and other welfare measures for the various stakeholders. G. Governance. The risk of this factor can be considered by adjusting the impact of poor governance on revenue in the form of penalties, fines, taxes, etc.